And so my job here is just to put you guys in front of the information. I'm no expert, all this good stuff. My goal as a young adult myself is to put you guys in front of the information, tell you guys stuff that you maybe never heard of or maybe heard of, but it was kind of in passing, so you didn't really think about it and don't really know what it is. That's my job, is to put you in front of that type of information. That way you can go do your own research and determine, hey, are bonds a good investment for me? Or are they not a good investment for me? That is for you to determine. Yo, what's goody? What's goody? Latrell in a hoodie, and welcome to another episode of the Brother Next Door podcast, where we talk about finance, personal development, and skills to get you further in life to extra steps, and my own personal experiences. In this episode, we're talking about bonds. So we're going to talk about, government bonds. We're going to talk about municipal bonds. We're going to talk about company bonds, all the good bonds. And so we're just going to get right into it. But before that, right before we get right into it, go ahead and leave a like. Go ahead and subscribe. If you watching just to watch, go ahead and subscribe while you watch. You feel me? Leave a like, leave a comment, leave all that good stuff. And we're going to get right into it. So what is a bond? Understand the difference between a bond and a stock. So when it comes to stocks, you are investing into the company, but in exchange for that investment, you're getting a piece of that company, right? So you're owning a small share of that company. But when it comes to bonds, what you're saying is, or what the company is saying is, hey, I don't want you to own a piece of the company, but I do want to borrow some money. Let me hold a couple dollars. Let me just hold a couple dollars. I'll give you interest on your couple of dollars, and then I'll give you your principal back. And so the principal is what you initially invest to the company or let the company borrow. So that could be $100, that could be $1,000, right? It could be whatever the company sets their price at. And so if it's $1,000, then it's like, hey, let me hold $1,000. Give me about 20, 30 years, I give you your $1,000 back, right? And within that $1,000, or within those 30 years or 20 years, whatever the case may be, they're going to pay you interest every single year. Now, it could be every 6 months. It could be once a year, whatever it may be. But every year, they're going to pay you a certain amount, the interest. In other words, it's called a coupon for lending them that money. So you can think of yourself as being the bank lending the company a little bit of money, which is cool, right? And so the idea behind bonds are they're the safe bet. They're the go-to, right? Which, yes, to a certain extent they are, because if they're secured, you're going to get your money back most likely. But if they're not secured, if that company goes bankrupt, it's wraps. Your money gone, right? And so that's something to consider when it comes to bonds is now your money's tied up for however long that bond is supposed to be held. So like I said, there's bonds that go from 0 to 2 years. That's called a commercial paper. You got 2 years to 10 years. That's called a note. And then 10 to 30 years are just bonds. And so, different bonds have different lengths of time. And so, you can pick which bonds, and how long you want to hold them for and all that. But understand your money's going to be tied up with that unless you go ahead and sell. Now, the problem with that is you're not going to be guaranteed your principal back. And so if you put in $1,000 and that bond now is trading, at $900 or $800, you're not you're not getting your $1,000 back, right? And so that's also something to consider. Yes, bonds are tradable. Yes, you can sell it in the market, but understand your guaranteed investment or that money that you invested initially is not guaranteed, right? And so take that into consideration if you're going to think about trading bonds is you might not get your initial investment back. So think about that before you just throw money into bonds. Now, understand when it comes to when they're lower, it's called a discounted bond, right? And when they're higher, they're called premium bonds. And so when you see those, out in the markets, like what's up, discounted bond? I mean, they're pretty self-explanatory, but what's a discounted? What is a premium bond? Those are the differences. So understand some of them can be paid off early, called a callable bond. So they're saying, hey, we already raised enough money. We're going to give you, your bond back, or give you your initial investment back, or your par. The initial value of the bond is called a par. So we're going to give that back to you. Appreciate your service. And so understand what changes the value of these bonds is the interest rate in the economy. And so understand, if interest rates go up after you buy, then the value of your bond goes down, right? And so why is that? Because now the value of the interest rate of the bonds now, or the coupons, have gone up with interest rates. And so understand, now they're willing to give you, $1,000 bond with, 10% interest compared to the 5% interest they gave you, right? And, that could happen, that couldn't happen. But just for, example, now bonds are the same, amount initially, $1,000. But now we're going to give you 10% on your money for letting us borrow your money. And so now your bond, which was $1,000, the same price, but they're only giving you 5%, is worth a lot less. So now if you go to try to sell that bond, right, you're not going to get that initial $1,000 unless you hold that bond all the way until the maturity date, which is the date that y'all agreed upon getting that money back. So think about that before you go into bonds. Think about that. And so understand, how do you decide on, okay, should I go with this bond? Should I go with that bond? You should look at the bond rating. This is a factor of multiple things: the score, the credit score of the company. How trustworthy is this company? Does this company pay its debts back on time and in full and all this good stuff? How's the company doing just as a company and as a company as a whole? Are they making profits? Are they losing money? All these different things you have to take into consideration. What's the interest rate on the loan? How long is the bond? All these things are taken into consideration when it comes to this bond score, right? And so you got to understand, bonds with higher interest rates, that usually means they're more riskier. So they're trying to entice you to go into it, to buy it, by giving you a higher interest rate or a higher return on your money. But the ones that are lower, right, are saying, hey, this is, a safer bet. You're more likely to get your money back at the end of the term, but you're not going to make as much money in the long run, right, or at the end of the day. And so you got to take that into consideration. And so how does this relate to the economy? So how this relates to the economy is, understand the government as a whole controls inflation based off interest rates, right? So you've heard the term, they're raising interest rate. Interest rates are the highest they've ever been. They're lowering interest rates. Rates were at zero after the pandemic. All interest rates. Understand, they are controlling inflation with interest rates. So when inflation goes through the roof, which it is now, and they try to control inflation with interest rates, it's supposed to bring inflation down. But the problem we're having now is we've been doing that for so long that now the cause of inflation is interest rates. So we can't solve the problem with the problem that caused the problem. You see what I'm saying? You picking up what I'm putting down? That's the issue that we're having now. And so if they raise up interest rates, everything's is just going to become more and more unaffordable. So that's why people are taking out more and more loans, going into deeper and deeper credit card debt, because everything is unaffordable. And so now the Fed has their hands tied behind their back, because it's like, well, we can't do what we've been doing, which is raise interest rates, because that's just going to make everything even less affordable. But we can't leave it the same because everybody's still buying stuff with debt. And so now we're at this bubble, right? Where it's just like something's got to give. Something's got to give. And so what that is, I don't know. I'm no economist. I'm not going to, speculate or do none of that. But based off what I'm seeing, based off what I'm researching, something has to give. And to me, it's not looking good. That's just my opinion. It's not looking good. But that's not the main topic of this episode. The main topic of this episode is bonds. And so my job here is just to put you guys in front of the information. I'm no expert, all this good stuff. My goal as a young adult myself is to put you guys in front of the information, tell you guys stuff that you maybe never heard of or maybe heard of, but it was kind of in passing, so you didn't really think about it and don't really know what it is. That's my job, is to put you in front of that type of information. That way you can go do your own research and determine, hey, are bonds a good investment for me? Or are they not a good investment for me? That is for you to determine. But that's the quick, concise, concise definition and understanding of bonds in my eyes, right? And so understand, just to recap, they're basically just a way for you to give companies money, but you don't own parts of that company. And so understand, if that company is the next Amazon and they're doing great, you you don't get to, become a millionaire off the, thousands of shares you bought early on. No, you borrowed that money. And so they said, okay, here's our contract. We're going to pay you a set amount in interest for that amount, and then we're going to pay you back your principal. And that's that. And so that's the difference between stocks and bonds. There's benefits to stocks. There's benefits to bonds. There's downsides to stocks, of course. And there's, of course, downsides to bonds. But I want to put this information in front of you because I've talked about stocks, but I haven't talked about bonds. And so hopefully you guys understand and picking up what I'm putting down, and will go and do your own research to determine if that's, something you want to put in your portfolio. I'm not a financial advisor. I'm not telling you to go out and buy bonds. I'm not telling you to go out and buy stocks. I'm just telling you what they are. And hopefully you go and do your own due diligence and decide for yourself if that is the right investment for you. I hope you guys are enjoying the podcast. Leave a 5-star review. Let me know what you like. Let me know what you don't like. Let me know what I can improve on. Let me know what you guys want to hear about next. And I will see y'all in the next episode. Peace.